Hey there, fellow taxpayers. Imagine saving $6,000 on your taxes in 2025 sounds too good to be true, right? Well, stick around because I'm about to reveal a game-changing tax deduction that could put thousands back in your pocket, especially if you're approaching retirement or already enjoying your golden years. But before we dive deep into this incredible opportunity, take a moment to hit that subscribe button and notification bell so you never miss out on vital tax-saving strategies like this one. Now, let's talk about what's making waves in the tax world for 2025. The IRS has introduced a groundbreaking provision that's specifically designed to benefit retirees and those nearing retirement age. But here's the burning question: are you among the lucky ones who qualify? And more importantly, what's the real catch behind this seemingly generous offering? You might be wondering why the government would suddenly offer such a substantial tax break. Well, it's not as sudden as you might think. This provision has been in the works for years, stemming from the growing concern about retirement security in America. With millions of baby boomers entering retirement and Generation X not far behind, lawmakers have been under increasing pressure to provide more financial support for our aging population. Let's break down exactly what this $6,000 tax deduction means for you. Unlike a tax credit, which directly reduces your tax bill dollar for dollar, this is a deduction that lowers your taxable income. For instance, if you're in the 22% tax bracket, this $6,000 deduction could potentially save you $1,320 in actual tax dollars. Not too shabby, right? But that's just scratching the surface of what this provision could mean for your financial future. Now, you're probably asking yourself, what's the catch? Because let's face it, there's always a catch when it comes to tax benefits. Well, you're right to be skeptical. The first major requirement is age. You need to be at least 55 years old by December 31, 2025, to qualify. But age is just the beginning. There are several other crucial criteria you need to meet, and I'm going to walk you through each one of them. One of the most significant requirements involves your retirement account contributions. To qualify for this deduction, you need to have made consistent contributions to a qualified retirement account for at least 5 of the past 10 years. This includes traditional IRAs, 401(k), and similar retirement vehicles. The government wants to reward those who've been proactive about saving for retirement, not just those looking for a last-minute tax break. But here's where it gets interesting and potentially complicated. Your income level plays a crucial role in determining whether you can claim the full $6,000 deduction. For single filers, the deduction starts phasing out at $75,000 of adjusted gross income, AGI, and completely disappears at $90,000. For married couples filing jointly, these thresholds are $150,000 and $180,000, respectively. This means if you're earning above these amounts, you might only be eligible for a partial deduction or none at all. What about those of you who are still working? Here's some good news: you don't have to be fully retired to claim this deduction. In fact, the provision was designed to help both current retirees and those transitioning into retirement. However, if you're still employed, you'll need to meet additional requirements regarding your employer-sponsored retirement plans. Let's talk about something that many people overlook: the interaction between this new deduction and other retirement-related tax benefits. You can still contribute to your IRA or 401(k) and claim those traditional tax benefits. This $6,000 deduction is completely separate and doesn't affect your ability to make regular retirement contributions. Think of it as an extra layer of tax savings specifically designed for those in or near retirement. Now, here's a crucial point that you need to understand: this deduction isn't automatic. You'll need to actively claim it on your tax return, and the documentation requirements are quite specific. You'll need to maintain records of your retirement account contributions, proof of age, and detailed income documentation. Missing any of these could result in the IRS denying your deduction, so organization is key. But what if you're married? How does this work for couples? Well, if both spouses meet the age requirement and other criteria, each person can claim the deduction separately. That means a married couple could potentially deduct up to $12,000 from their taxable income. However, remember those income limits we discussed earlier, they still apply to your joint income. Here's something that might surprise you: this deduction can also benefit those who've already started taking required minimum distributions, RMDs, from their retirement accounts. In fact, having RMDs doesn't disqualify you from claiming this deduction. However, you'll need to carefully calculate how your RMDs affect your overall income concerning those phase-out thresholds we discussed earlier. Let's address a common concern: what if you have multiple sources of retirement income? Maybe you have a pension, Social Security benefits, and investment income. The good news is that the source of your retirement income doesn't directly affect your eligibility for this deduction. However, all these income sources contribute to your AGI, which does matter for those phase-out thresholds. Many of you might be wondering about the timing of claiming this deduction. While it's for the 2025 tax year, you'll actually claim it when you file your taxes in 2026. However, there are steps you need to take throughout 2025 to ensure you qualify. This includes maintaining proper documentation and potentially adjusting your retirement contributions or other financial decisions to stay within those income limits. Speaking of planning, let's talk about strategies to maximize this deduction. If you're close to the income threshold, there might be ways to reduce your AGI to qualify for a larger deduction. This could include increasing contributions to tax-deferred retirement accounts, timing your investment sales, or considering charitable giving strategies. However, it's crucial to work with a qualified tax professional to ensure these strategies make sense for your overall financial picture. Now, here's something that often gets overlooked: the state tax implications. While this is a federal tax deduction, some states might treat it differently. Depending on where you live, you might get additional state tax benefits, or you might find that your state doesn't recognize this deduction at all. This is another reason why consulting with a tax professional familiar with your state's tax laws is so important. Let's address some common misconceptions about this deduction. First, it's not a one-time thing. You can potentially claim it every year you qualify. Second, it's not limited to traditional retirement accounts. Qualifying accounts include various types of retirement savings vehicles. And third, you don't need to be taking distributions from your retirement accounts to qualify. You just need to meet the age and income requirements. What about the future of this deduction? While it's currently set for 2025, there's already discussion about extending it or making it permanent. However, tax laws can change, and there's no guarantee this deduction will continue beyond 2025. This uncertainty makes it even more important to take advantage of it while it's available. Here's an interesting aspect: this deduction can be particularly valuable for those who are still working but planning to retire soon. Why? Because it can help offset the income from your final working years while you're potentially in a higher tax bracket. This makes it an excellent tool for transition planning as you move from your working years into retirement. Let's talk about some real-world numbers. For someone in the 24% tax bracket who qualifies for the full $6,000 deduction, this could mean $1,440 in actual tax savings. Add in potential state tax benefits, and the savings could be even more significant. This is real money that could help cover healthcare costs, fund travel plans, or simply provide more financial security in retirement. But what if you don't qualify this year? Don't give up hope. There might be steps you can take to qualify in future years. This could include adjusting your retirement contributions, managing your income sources, or timing certain financial decisions. The key is to start planning now, even if you're not yet eligible. As we wrap up this discussion, let's recap why this deduction is so significant. It's not just about the immediate tax savings, it's about recognizing and rewarding those who've planned for retirement. It's about providing additional financial support during a crucial phase of life. And most importantly, it's about taking advantage of every opportunity to secure your financial future. Remember, while this $6,000 tax deduction represents a fantastic opportunity, it's just one piece of your overall retirement and tax planning puzzle. The key to maximizing its benefits is understanding how it fits into your broader financial picture and working with qualified professionals to make the most of it. I hope this detailed explanation has helped you understand this new tax deduction and whether it might benefit you. If you found this information valuable, don't forget to hit that like button, share this video with friends and family who might benefit, and subscribe to our channel for more.